Welcome back to Indian Open right here on BloombergQuint Live. Lots of things around the economy, the banking regulator and the related spaces. The banking regulator, for example, has already warned that the asset quality has deteriorated further. The RBI blames the macroeconomic slowdown for the rise in rotten apples. What's worrying that the economy is not expected to turn around over the next few months as well. The IMF has also warned that it's likely to lower India's growth forecast. And say it's worried over India going off the track in the fiscal prudence. More importantly, there are things that the Reserve Bank of India is doing, including the second leg of Operation Twist that has happened. And the government has mentioned that, or an official has mentioned that divestment of some of the units like BPCL may not happen too. So does that pose a risk to the fisc? So lots of questions to pose and discuss. Let's get in DK Joshi, Chief Economist at CRISIL, who joins us right now on the show. Mr. Joshi, good having you. Thanks much for joining in. A word on how do you think the markets may react to yields in the near term? We were speaking to Anand Narayan in the morning, and he was saying that the market may look to stick with the Reserve Bank of India, and Operation Twist and the second leg that has been announced is the more prevalent and prominent yield impacting force. But we also have these noises of how divestment may not go ahead as planned, and that might put stress on the fisc as we see it. How do you see this push and pull?
Well, I think in the short run, the yields will be maintained around the current levels. But I think eventually, when you come to the end of the fiscal, I think after the budget, we will see some stress in the fiscal numbers unless government cuts its expenditure quite sharply. So at that time, I think there will be some upward pressure on yields. And our forecast currently is yields at 10-year yields at 6.9% by March 2020, which means mild lift from the current levels. So the fiscal pressure will be visible on the yields.
So you are suggesting that from the 6.5, even if the RBI continues to do its version of Operation Twist, the leg 3, leg 4, the yields might still inch higher.
Well, I think fundamentally, I think if government borrows more, I think then it will get reflected in yields. Right now, what's happening is I think the banks also have little appetite for lending in the market in general. So they are putting money in the GSEC. So that's why the demand for GSECs is strong, and I think that's also helping. And the central bank's operation is actually going to help maintain yields at low levels. I think, but beyond a point, I think if fiscal pressures emerge, I think they will also show up in the yields.
Okay.
At least to the 10-year yields.
Okay. By the way, banks are doing very well today, and I reckon that is in part due to this. When the yields have come off, and the market would want to believe that some of these banks would get the MTM gains. Look at the bank Nifty; it's up about 236 points currently at about 0.74%. A sense, Mr. Joshi, on the health of the banking space, because while we all know that they have fought through a lot of troubles, the SBI chief was on record saying that the worst of the NPA issues and asset quality issues would be behind post-March 2020. Would you be as sanguine?
Yeah, I think we also believe that the non-performing assets of the banking sector as a proportion of their advances will now start heading down. It's right now, as of now, it's a gradual process. I think one should remember that even if they come down, they still remain uncomfortably high. So I think it will be a gradual process. The speed with which NPAs are being generated, I think that has definitely slowed down.
Okay. The other important conversation, Mr. Joshi, is whether you believe there are upside risks to inflation. I mean, crude being what it is, crude at the levels that it is at right now, is that one major threat. But a happy problem to have would be the small signs of rebound in the rural economy, as a clutch of companies are telling us. Now, if that brings about some spurt in core inflation as well, and if it remains sticky for the next few months, what does that do to the inflation print, and thereby does that also strengthen your belief of the yields moving up higher?
Well, I think inflation will. Analysts have scaled up their inflation forecast for this year, and we also believe, I think, that the inflation will average at a rate of around 4%, which essentially means that the second half inflation is picking up. I think as of now, I think it is largely due to idiosyncratic factors. The core inflation still remains weak, and I think despite some pressure points emerging on the core inflation, particularly when the telecom prices are raised, I think going ahead, I think that will show up in core. But otherwise, I think economy is well below potential. So the generalization of food inflation into other sectors. So,
Okay, I think we're just losing that feed a bit. We'll just try and see if that can get corrected. But keep in mind, I think the point that most people would be grappling with would be, would inflation, as Anant was saying, bounce back and remain sticky? And does that force the RBI's hands in the Fed policy? There was a bit of a surprise in the policy gone by when they stayed pat on the rates. And if indeed inflation bounces back, and if indeed the government in the budget does the tinkering with the taxes as they've spoken about, which may not look the fisc numbers too attractive, will it force the RBI's hands to stay pat or not sound dovish? That's the key question I think most people would be working with. So, but sorry, Mr. Joshi, we're finishing your point with regards to inflation and the issues that it may pose.
Well, I think the point I was trying to make is that inflation has been scaled up, but I think it is not due to the fact that there is a sudden surge in demand and it's causing inflationary pressures. I think these are supply-side shocks from particularly from fruits and vegetable category, which I think happens once or twice every year, and that's definitely going to correct. But the some pressure points could emerge from telecom prices going ahead, and maybe the pulses category, which typically sees a surge every 2 to 3 years. I think, but apart from that, I don't see. I think the pricing power returning to the corporate sector so soon that they can start raising prices going ahead. So I think inflation is still, despite the headline going up, I think it's still. I would still regard it in the weak category.
Okay. What does all of this do to the currency? We've discussed yields at length. What about the currency? What is your thought? I mean, I'm just trying to figure out if you have some view on what the rupee could do in the near to the medium term. The dollar has started to strengthen a little bit against all major currencies, but that notwithstanding, what do these near-term challenges pose to the rupee?
Well, I think rupee depends on a variety of factors. I think, and one of the factors that will support the rupee this year is that we're going to end up with a lower current account deficit. So that's a comfort factor. So you need, I think, and it also depends on, I think, how the capital flows into the economy continue. So there are some factors which weaken the economic fundamentals, like falling growth and pressure on the fiscal deficit. But there are some other things which I just mentioned, like current account deficit. And if oil prices remain low, I don't see much pressure on the rupee. I mean, as of today, we have our outlook on rupee is that it will hover around 71, a couple of basis points up and down.
Okay, Mr. Joshi, we'll leave it at that. Thanks so much for taking the time out and speaking to us at BloombergQuint and giving us your thoughts.
Thank you.
Well, lots of things discussed, and mind you, a lot of things to be discussed over the course of the next few days as well. One, what the yields have done today notwithstanding. The fact that crude has jumped to $68 per barrel is that one key issue that should worry most people. In India, we've rejoiced in the past when crude went down. At sub 60, Brent was lower, NYMEX was lower. And now, with Brent being at 68 and NYMEX at 62, there is cause for worry. That's about $8 to $9 per barrel uptick that we've seen in crude prices, and that should be a worry for the economy. Okay, the next conversation is with a stock that has been doing, is with the management of a company that has been doing, the stock of which has been doing really well, and that's Dixon Technologies. Now remember, viewers will remember that how Xiaomi captured a sizable chunk of the Indian television market, which put Dixon Technologies in a good place since it's one of Xiaomi's biggest suppliers. But there is more to Dixon than just Xiaomi, really. They're spending some money on expanding the TV facility. It looks to bag another big order. There's a brokerage note that has come out today which says that they are upping the target price of Dixon Tech from the earlier 3750 odd to northwards of 4400. Let's ask about how business is shaping up for Dixon Tech with Atul Lall. He's the managing director of Dixon Technologies, joins us right now on the show. Mr. Lall, good having you. Thanks for joining in. Not that you look at the stock price, but I'm sure you're not complaining. The markets can't seem to get enough of the prospects for your business?
So I think we are in a fairly strong space across all our verticals. We have been sharing a strategy with all the stakeholders. The strategy is that we are continuously working on new customer acquisition across all the verticals. We are building up the scale to bring in operating leverage, which helps us in improving the profitability. We're trying to build up more and more our own design solutions. So that means migrating from prescriptive low margin business to a relatively higher margin business by offering our own design solutions. And fourth is enhancing the stickiness with our existing customers so that we can have the larger pie of their share. I think across most of our verticals, although we are at very different stages, but that is what we are pursuing, and that is helping us. I think we are in a growth mode, so we are in a fairly high growth mode in spite of the demand being slightly slow. We are doing fairly well.
Sorry, did I hear you say that demand is growing slightly slow? And the reason why I'm intrigued by this is, one, when we spoke to Vijay Sales on how is it that they are seeing the offtake, somehow their view and a view of some of the other large dealers was that people may not be buying soaps, they may not be buying biscuits, but they are going out and buying white goods without batting an eyelid. I'm just wondering, why would demand be slow in such a scenario?
You see, normally post-Diwali, the demand slows down in because there is definitely an uptick around the festive season. So I think that kind of a small slowdown is there. I feel that the normal pickup will happen from next month onwards. In our case, because of our new customer acquisitions, in televisions, in lighting, in washing machine, again, we have acquired a new account to whom we have a large account to whom we start delivering early January. In next 2 days, in fact, we start delivering to them. Similarly, in mobiles now, we have started manufacturing for a new large anchor customer, Samsung. So I think we are on a high growth mode.
Yeah, you are. But you're saying that this post-Diwali period, I'm just wondering, by virtue of your experience, how long does this lull last? Because yesterday, for example, not that it's a product portfolio of yours, which is air conditioners, but we were talking to Blue Star, and they mentioned that the post-Diwali numbers have looked a bit lackluster compared to what they anticipated. But maybe they could pick up. So your mind, when would this lull get over? Is it seasonal in nature, and does it pick up from the months of January, February?
So I feel it's seasonal in nature, and I think from January onwards, it's back on track. That's what I feel.
Okay. The last time that we spoke to you, and you would remember that was after the Flipkart and the Amazon sales wherein Xiaomi really had a big move. You were mentioning that, don't look at Dixon only as a key Xiaomi supplier, but we're doing a lot of other things, and you are eyeing some other clients as well, and other categories as well. Can you tell us a bit about it?
So in televisions, Xiaomi undoubtedly is our anchor customer. A large portion of our revenues come from Xiaomi. But we are in the process of acquiring another very large customer. I'm not able to share the name as of now. But the manufacturing for this new large customer is going to start from January end. We already have in our portfolio large customers. We have an anchor relationship with Panasonic, with Senyo. We do it for Flipkart. We do it for Lloyd. We do it for various private labels. So we have a large portfolio of customers. In mobiles, I shared with you, we already started manufacturing for Samsung. In washing machines, we have Samsung as our anchor customer. But apart from that, we have huge relationship with Panasonic, with Haier, with Lloyd, with various private labels. Similarly, in lighting, we are doing almost 40-45% of the Indian bulb requirement, and we have very deep relationships with all the major brands selling within India. So I think in Dixon's case, customer acquisition is an extremely important part of our strategy. and we keep pursuing it. And I think the team has done a wonderful job in acquiring new customer base, which has led to a significant growth in this year's numbers.
Okay. Couple of questions. This whole conversation that happened about a month ago, wherein countries in Asia and Southeast Asia should take advantage of the US-China trade war and how a lot of manufacturing shifted to Vietnam and not to India. I'm wondering, from a back-end manufacturing process for electronic goods, have any companies, large global companies, moved or talked of moving some bit of their global manufacturing processes from other countries to India, and therefore might benefit companies like you, if not now, then in the near term?
So that has already started. One of our large anchor customers will start exporting for them to US. And many large customers of ours are looking at creating an alternative to China and Far East within India. So we're very confident that it's going to happen. And for us, it will turn into an actual revenue stream in beginning of next fiscal. I'm fairly confident about it. So I think to start with, it's going to happen with lighting. And then it's going to follow up with various other customers. And we have ourselves created an organization, a small organization in the US, for exploring these opportunities. I'm getting a significantly positive feedback from that. So I think it's going to take time. We'll keep pushing it. We'll keep building our organization. We'll keep building our resources in our labs to design products for them. I feel strongly about it that in a couple of years, India will emerge as a major hub for various consumer durable and electronic products.
But there the sky is the limit, and I'm guessing that because it is still in the initial stages, there is no chalked out plan of what kind of manufacturing capability expansion that you need, right, Mr. Lall, for that particular thing?
So I feel as far as the manufacturing capability is concerned...
capacities, not capability, sorry. Let me rephrase myself.
Capacity is also concerned. So let's say in lighting, today we are within the top 5 globally as far as the LED bulb is concerned. We are expanding our capacities in downlighters and battens and tube lights. From existing, let's say downlighters around 200K to 1 million, in battens around 700K to 2 million. So we'll have global scales, and these capacities will be in place in the next fiscal. In fact, the first quarter itself. In televisions, we are expanding our capacity from 3.5, 3.6 million to 4.4 million. Which is almost of a global scale, not a very large global scale, but a global scale of a medium-sized Chinese company. So we are building this capacity with very prudently, with a minimal capital allocation, and that's what our strength is. So I feel that Dixon and the various other Indian companies as well are sitting on a large potential, a large opportunity for international markets.
Okay, just one final word, Mr. Lall. Actually, I have one more question then on the return ratios too, which are looking very healthy. But just one final word on this aspect. A lot of conversation around how companies like you are now providing that large option of import substitution even to global brands, because the white goods market is largely dominated by global brands. Would you believe that in that aspect too, we are nowhere close to peak substitution already been done? Are there some numbers or are there some percentages in your mind that you would have that we've reached maybe 20-25% of that import substitution pie and there is more in store? Is there some estimate?
So this is a journey which has just started. Now, let's say televisions or washing machines, let's say washing machines, right? My understanding is that almost 90% of the washing machines being sold in India are manufactured in India.
Okay.
Similarly, mobile phones, more than 90% of the mobile phones sold in India are manufactured in India. However, there are two things. One is when the journey starts, the ecosystem is going to develop, and what's going to happen is the deepening of manufacturing. So the value addition within India is going to increase because the various part suppliers are coming into India and setting up bases here. So one is enhancing of depth of manufacturing. Second is that the domestic market of consumer electronics and durables would be served through domestic manufacturing. And third is, in phases and category by category, in many of the product categories, India is going to emerge as a comparative, highly competitive, cost competitive player for servicing the domestic, the global markets as well. So it's going to be a way forward across all the three things: deepening of manufacturing, servicing the domestic market completely, and third, global markets.
But it's not import substitution. If 90% is manufactured in India, then import substitution, at least for washing machines, it's not a case. It's more.
No, it's not a case.
It's not.
So
it's more
in
deepening
washing
of
machine, we already have a huge value addition within India.
Okay. Last point, as you grow in size and shape, the estimates of most people that I look at the notes, there is a note that came out a few days back, there's a note that has come out today, which all speak of how you will maintain or better your return ratios, FY21, FY22, FY23. Are these estimates realistic? Can you expand from where you are on ROEs, ROCs? You're probably mid-30s currently on both of them.
Yeah, because we're extremely conscious about our capital allocation. And the capexes are controlled. We are an extremely low debt company. The total debt on the balance sheet end of December or end of September is going to be somewhere in the range of 40 crores. We expect a revenue of around 4,700, 4,800 crores. So the return ratios are going to keep on improving. The reason for that is that my fixed asset base is fungible. And that means the surface mount lines, which take a large chunk of my capital investment, on the same lines I can do my mobiles, my bulbs, my televisions, my cameras, my DVRs. So it's fungible assets. Second, a large investment goes into injection molding and polymer processing. It's the same. On the same machines, I do my TV cabinets. On the same machine, I do my washing machine parts. On the same machines, I do my plastic parts for lighting. So with the commonality of the asset base, the operating leverage kicks in and the asset utilization improves, which further helps in improving the return ratios. The second part is that we focus a lot on our operating cycles. So if you see the total work and the total operating cycle, which is 0 days, end of September, and we feel that we're going to be operating in this range of 0 to 3 to 4 days on the working capital side as well.
Well, okay. Keep up the good work is all I can say. And thanks for joining in today and giving us a lowdown. All the best
for the year ahead.
Well, that's Dixon Tech, and the stock is on a roll really. After moving up 4.5% yesterday, is up another 1.5%. This year has doubled with a lion's share of the move. Actually, nearly 100% of the move coming in from the August lows, really. I mean, that's quite stunning. For this counter was maybe at 2,000 or thereabouts. 6 months, it's actually gained about 74.84%. Well, a lot of other stocks are doing well, but the Bank Nifty is the one to watch out for. We wrap it up on this leg of Indian Open. Keep an eye out for the Bank Nifty. I'm sure the FNO show will take forward that action on the other side as well. Thanks for tuning in to Indian Open.